PSUs, by the way, at that, which are back in focus and back in favor. NTPC, SBI, ONGC, Coal India. These are the ones that are really up and about. BPCL. So, the top tally on the Nifty is actually all PSUs. And then you have some names like Infosys, HCL Tech from the tech space, Wipro. So, tech is good. PSUs are good. ITC is seeing some buying. Those are the pretty early trends. And actually, on the PSUs, just to note, even in the broader market, beyond the Nifty as well, there's a lot of buying. BHEL 7%, NBCC 7%, NHPC 7%, PFC 6%, Aircon, Hudco, GAIL, it's just a long list. RBNL, BEL. So the pendulum has been swinging wildly away from PSU, away from CapEx on June 4, and today is a very, very different day, as some of these stocks are back in the radar and the PSU rally is cooling off.
Well, that's right. So, be a couple of stocks that we highlighted yesterday. If Amravati is going to be in focus, then stocks like ACP are well positioned. We'll have to see how that dream plays out. Yesterday, the stock was up close to around 18-19%. A lot of the TDP spokespersons are talking about Mr. Naidu taking oath in Amravati in a couple of days and then focusing on their development plan as well. The stock is up close to around 18%. Just to alert our viewers, for this week itself, it's up more than 35%. So take note of that before taking a fresh call on the stock. Heritage Foods, that's the other stock where Mr. Naidu is the promoter entity. And that one, in fact, is up close to around 10%. And in this week, it's up more than 45%. I'm looking at the profitability of the last year was around 100 crores. Some believe that that will improve dramatically because they had some, low margin products that had to get sold in the past year. They're also focusing on higher value-added products. So that's why that stock, in fact, is moving up. But as of the last year, the profitability is only 100 crores. They're expecting it to move up drastically. For the timing, it's running on that, new Chief Minister of Andhra Pradesh, Mr. Chandrababu Naidu. So that's why, in fact, that's doing pretty well. A few more notable movers. You have Kochi Shipyard. That stock's flying away in today's trading session. It's up close to around 8%. Keynes as well is moving very, very well. So these are some of the top volume movers as well. And Titagar is another stock that's up and about in today's trade. Hudco, stock took a bit of a break. Week to date, mind you, it's still down close to around 10%. But for today's trading session, it's up close to around 7%. PFC and REC, they're back on the buy list. Both those two stocks are higher. And Snowman Logistics as well. Yesterday the stock was up close to around 8% odd. The promoter entity has been buying from the open market out there. And in today's session as well, Snowman Logistics is up close to around 3% odd. So keep that one as well on your radar. Prashant.
More normal markets, guys, things are looking a little better, much better, and more settled. On wild swings in either direction, but that's exactly what we've had. Pull up NTPC, if you will. It's one of those stocks which is still, it's of course one of the largest published names. The recent high was about 393. It's still at about 355, even with today's 4% pop. When you're talking about Coal India, I think this point yesterday morning, it's not as if the space is done and dusted, but I think there should be a little bit more focus in terms of larger, more liquid, more quality names. Coal India, the high was 527, stock still at about 468. Keep an eye on a few of these names. Market breadth, I have to say, is I think about 9:1. 9 advances to 1 for 1 decline. So it's overwhelmingly on the positive side.
I just wanted to point out one more space, Prashant. That's housing finance companies. Interesting moves on Awas, on Home First, or in LIC Housing Finance. There was a note this morning on Jefferies. Now, again, people are guessing what the government is going to be doing, and Jefferies believes that there could be some more SOPs and, a little more sweeteners added to that affordable housing scheme, and that could work well for these financiers.
On the day of the election, if you remember, we were talking Nal, Jal, what next? Housing, perhaps, right? As a bit of a focus area.
And he's been saying that, right? That they've made, I think it was 3 crore houses, and they're looking to add a tally and go up to 4 crores in the third term. So
it seems like a natural area to focus on. So we'll see. These are big moves. PNB Housing, for example, had a big move yesterday, so it's a little quieter today. It was up about 7-8% yesterday. All right, what else? BHEL is seeing a sharp up move. BHEL is the #1 volume-led gainer right now, 275, so coming back up. So that power theme is still very much there. I sort of mentioned NTPC yesterday. Then look at REC and PFC. Both are up 5% apiece. 481 on REC, 469, 470 on PFC. The defense names, BEL is up 5.5%. So 274 BEL. Adani Power, it's basically it's Adani but also power. So 5.5% there, 767. It had a big euphoric move on Monday. NHPC is up 6%. Again, power. There is RVNL, which is up 6%. Cochin Shipyard is coming up with a 6%. Okay, 8.5% pop. So 1827. I mean, this is, looking at this open and the kind of stocks which are moving, this looks like it's almost business as usual from a market perspective, right? So there was that shift to the consumer staples kind of name for a day, 2 days, but it's right back. Hoodco is up 7.5%. Hoodco, these are large moves and very large volumes right out of the gates. EIL is up 7%. EIL Engineers India 231 on EIL. All PSUs. IRCON is up 5.5%, 6% actually, 252 on IRCON. BEML is up 7%, 3935 on BEML. Garden Reach Shipbuilders is up 8.5%. There was a bit of a break with PSUs, but they're back, and how 1280 on Garden Reach. I can spot more names here. Century Textiles, of course, there's that sort of news flow. With regards to Birla Estates, Sonal highlighted that 10% on Century Textiles. Stock is past the 2,000 rupee mark. NLC India is up 7%. That's Neyveli Lignite. And so on. Railtel is up 6%. And volumes are not lacking at all. It's a big volume-led open that we're seeing. There is Chennai Petro, RITES, GSFC. I could go on with the kind of open that we have got. Really vibrant and PSU-led through and through is what you're seeing. 100+ points in Nifty, but it doesn't show you what's happening beneath the surface as I read out these names. Pankaj Tibrewal is with us. He's founder and CIO at Ikigai Asset Managers. Pankaj, good to have you with us here. Good morning. Thanks for your time. Prashant this side. It's as I was just reading out these names, these are return of the favorite, which is PSUs in a very big way. I remember we spoke, briefly over the last couple of days, and you were saying that maybe, start to look at some consumer type of consumer-facing names, right? On the more value side. Is that still your view, or do you think anything has changed at all over the last couple of days? I mean, you're someone who looks at fundamentals and valuations very, very closely. So I think your problem was not really the election result per se, but valuations to begin with. So let's start there, Pankaj.
Good morning, Prashant. I think the verdict had surprised everybody in the market, but it's business as usual because the mandate continuity would be there. What I've been saying is that when I look at the data points, let's look at 3 or 4 data points. The first data point is that the last 4 years, the rural spend has been flat at about 4 lakh crores. But when you look at the capex expenditure, it has moved from 3.4 lakh crore to be expected to be 11.1 lakh, which is almost a 3x jump in capex. The second data point is the private consumption expenditure has the slowest pace in the last 21 years. And don't forget that private consumption expenditure is about 56% of GDP. The third data point is that agri growth has been the slowest since 2015-16, when there were 2 consecutive years of drought. When you look at these 3 data points, and along with the fact that FMCG weight in the NSE 500 is at a 13-year low, and also the fact when you analyze the results on the election day, about 65 to 70 seats were lost by BJP, mostly on the rural belt. So our sense is that going forward into the next 12 to 18 months, a lot of resources could be diverted to spur consumption, because that's the weak data point which is there in front of all of us. And the message is loud and clear. So I think there could be some shift. I'm not saying that the capital expenditure would be stalled completely, but the 24% CAGR growth which we saw for the last 6-7 years probably can come down, and that probably may not bode well for a lot of names which are very highly priced. I think from a portfolio standpoint of view, I believe few things need to be done, because market will see readjustment as you move ahead. And what are those readjustments? One, I think it will be back to basics in investing. I think quality will be preferred over momentum investing. One should avoid the low free float stocks which are there in the market. One should not get carried away by only narratives, and also give precedence to quality and fundamentals. And over the last 2.5 years, we have seen a huge breadth being positive. I think the narrow down of the breadth could happen now. And it could be back to growth investing versus value investing, which we were seeing for the last couple of years. And I think if you don't readjust to the portfolio, it could be painful from the next 18 to 24 months perspective. But looks like some readjustment will go through as you move towards more policy making changes in the next 6 to 12 months.
Pankaj, hi. Good morning. Good to be speaking with you. The thing with these words, value and growth, is that I think in the last 12 months, the lines really started getting blurred. What were traditionally value stocks, right? I mean, they started behaving like growth stocks, trading at 70, 80 times P. And to be fair, in some cases, even earnings were coming in. So I think it was getting really confusing. But let's talk sectors, right? Because the market's narrative has shifted very quickly in the last 24 hours. On the result day, it was all about now there'll be populism. We need to be buying more rural-facing stocks. If you see the screen today, there seems to be hope that NDA 3.0 will stick to the capex agenda. Which one do you think it will be?
Surbi, I completely agree that they will stick to capex, investment-led growth, but we have to see what stocks are pricing in. The stocks were pricing in a lot of growth, and I think we will be a little surprised that managements would find it difficult to keep up to the expectations of the market narratives in the near term. Also, I think the valuation and margin of safety is limited in a lot of those industrial capital stocks. Don't forget, 4-5 years back, when I was in Kotak, we were the first fund house to call for China Plus One, manufacturing as a great theme. But I think at a price, I think most of these stocks look to be quite expensive, and the margin of safety is extremely low. We believe that when you look at the other parts of the market, I think markets are offering value there. One is pharma. I think pharma has kept surprising us on the earnings upside over the last 2-3 quarters. Private sector banks looks to be very well poised in terms of valuations. Some of the consumer names on both urban and rural discretionary looks to be quite good. And overall, I think it will be market breadth which will narrow down. It will not be the same broad-based breadth which we have seen. And also we track one ratio, which is high P to low P stocks on NSE 500. That ratio made a peak, which is high P stocks made a peak somewhere around 2021. And we saw the value trade of low P stocks played out extremely well. I think the big leg has played out. And from here on, we should see quality return back as a style from a portfolio perspective.
Pankaj, just a clarification. You said margin of safety is limited only in capital goods stocks or in any other part of capex / manufacturing as well? Just wanted to get the sector right.
So a lot of PSU names on defense railways, the margin of safety is less. A lot of capital good names, the margin of safety is less. And hence we believe that one needs to be prudent in terms of risk in the portfolio. I think risk has been underappreciated for the last 18 to 24 months. But if there will be uncertainty as you move ahead, because finally you have to accept it's a coalition government, there will be pulls and pressures across. And let's see how market takes it as you move ahead. I think the immediate focus will be on the government formation. And then over the next 45 days, the budget will be presented. And we will see how and what's the narrative in the budget going forward.
Hi, Pankaj. Good morning and good to see you. When you said that you all were on that China plus one theme, in your earlier avatar, and you got it spot on. I'm just looking at the near term. A few days ago, you joined in. You were talking about FMCG. Boom. Those stocks did quite well. So it's calls like this that that make you quite happy, I'm sure. But a couple of quick questions. On the Nifty itself, we made a high a few days ago of around 23,300, 23,400 roughly. Do you think the near-term peak is done for the Nifty? And also, since we're talking about the cabinet formation, now since you'll have a couple of allies, some part of the street is a little bit nervous. What if ministries like Defense, Railways go to some of these allies? Will it, change things? Will it, derail that entire growth, the entire measures that we've seen in the last 10 years or so?
So answering your second question first, Nigel, coalition government is not bad. Except the last two terms, which is 2014 and 19. Since 1989, India has been used to coalition governments, and we have seen growth despite of that. And don't forget, the biggest reform year was 1991, when Congress was in minority, and we unleashed the major reforms which the country has never seen. So I'm not against coalition, but it will have its own pulls and pressures, which will show up in the decision making over a period of time. But our sense is that when I look at the data points from a rural perspective and the spend which has not been there for the last 4 years, and the consumption has been slowest in the last 21 years, I believe that some part of the resources from the government side will be directed towards spurring consumption in the near term. And I think markets will adjust towards it. We believe that the earnings downgrade cycle in the entire consumption space is behind us. And probably from here on for the next 24 months, we should see an upgrade cycle starting to begin, or probably if not, earnings downgrade should stop. On the first question on markets, I am not a great market timer or a technical analyst, but let's look at the fundamentals. Nifty ended with 1,005 rupees of EPS last year, which is FY24. If I was to state street expectations, I think markets are pricing in 1120 to 1140 of earnings on a consensus basis for FY25 and about 1240 of earnings in FY26. When we look at that number and look at the market, I think markets generally bottom out at about between 16 to 18 times 1 year forward. And that's the number you should work out to see where you need to be aggressive in the market, despite of all negative news at that point of time, when that earnings or the P multiples come in, which is 16 to 18 times 1 or 18 months forward earnings. And I think that's something which will give you a fundamental anchoring from a bottom-up perspective.
Okay, all right, Pankaj, always good hearing your thoughts. Thanks a lot for joining in, and we look forward to chatting up with you as this market moves on. Well, let's move to our next management then. Uno Minda, they have partnered with Chuso Nuance Automotive to strengthen their electric four-wheeler portfolio. Mr. Sunil Bhora, the Group CFO of Uno Minda, joins us to talk about this development. Hi, Sunil. Good morning and good to see you in. Well, tell us more about this technical license agreement that you've signed. You know, one of the positives that the street is viewing this with is that it will increase your kit value. And I'm reading a Kotak note. They are saying that the kit value could approximately be around 1.5 to around 2.5 lakh, which is much higher than what it is currently. Your comment on this?
Yeah, Nigel, thanks for the opportunity. Yes, I think, as you know, for two-wheeler EV segment, before I come to four, I just give a little bit background. So we have been front runner in terms of setting our EV portfolio for two-wheeler and three-wheeler segment. And I think we have been communicating that we are working on the four-wheeler EV segment also. 3 months back, we have signed a TLA with Star Charge for the EVSE or the wall-mounted chargers. Yesterday, the board has approved signing of TLA with Innovance with the intention of converting that TLA into a joint venture subject to approvals. Coming back to the TLA, the kind of product profile which we will build will be sort of, we will have an e-motor, we will have an inverter, we will have a power supply which includes OBC, DC-DC converters, etc. Then you have e-compressor, e-controllers, e-axle. So there is a multiple products which will come into fold from the EV perspective. We all know that India EV market is growing at a significant pace. Last year, the PV segment has grown by almost 70-80%, and the market looks very, very aggressively. Government is focusing on green energy. So with all this put together, we believe that we will be the front runner in the four-wheeler EV space as well, like we have been in the two-wheeler and three-wheeler EV space.
All right, Sunil, but that didn't answer the question, right? The kit value of these e-axles along with AC chargers can range between 150,000 to around 250,000. Is that a rough number we should work with? That's a good range?
You are right, Nigel. I think that's a good range to work because a lot also depends on the size of the car, whether it's a 50 kilowatt or 80 kilowatt or 150 kilowatt or a 200 kilowatt motor, etc. So broadly, the range is right, but a lot also depends on what the market is absorbing, whether market goes with the lower segment A segment EV cars or a B segment or a C segment. But broadly, the range you spoke is right.
Also, another number there, Kotak is estimating that the supply of e-axles and chargers, it can be close to around 2,600 crores as in terms of revenue contribution for your company, Uno Minda. I'm just doing the rough math. It appears they are factoring in around 1.3 lakh units. Is that math as well reasonably on those lines? The aspiration is to get around 2,600 crores. Is that correct?
So Nigel, we don't speak about numbers because eventually it all depends on what is the size of the EV market going to be. So and it's only a multiplication factor, what you just spoke about in terms of the kit value versus the industry volumes and our share of business. So it's, I think, anybody's guess what's the EV penetration going to be and what will be the application factor in terms of various categories we spoke about. So on a broad range, yes, I think we should be looking at a significant revenue potential from this business. But as of now, I won't comment on the absolute numbers because, as I said, the EV volumes itself is very unpredictable range as of now.
Penetration now, Sunil, hi, morning, Prashant here. The penetration is 2%, right now, passenger vehicles?
That's right.
This note that Nigel is assuming 20% electrification of passenger cars, passenger vehicles by 2030. Is it 2 to 20% is a big jump, right? You think it's possible once it kind of picks up? Electrification, of course, is the future. Timelines, of course, we don't know. But your own thoughts?
Definitely, Prashant. I won't comment on the year, but 20% will definitely be a number, maybe 2030 or 32, because what we see as of now, there are projections of 17% by 30, 20% by 30. Everybody has different assumptions, and that's why I said normally we don't comment on the penetration or the volumes. But yes, as we move forward, I'm sure market will see at some time 20% penetration as well.
And these are products which you also sort of highlighted, right? Which is combined charging units, e-axle, inverter, motors. These are all. So you get the technology for all of this. Okay. And this is going to be, obviously, I mean, the agreement would be that you sell this here in India to OEMs here.
Yeah, we manufacture and sell in India. You're right.
Okay. And have you already spoken with OEMs with regards to this? I mean, you're obviously in constant conversation. So you would have done a check about, what is the sort of competitive landscape in these products like, and what's the scope?
Absolutely, Prashant. Like any new business you get into, you will obviously speak with your customers, and we have spoken with a lot of our customers who are working on a very aggressive EV profile. We also know the fact that the market is small and it will grow. A lot of our customers are maybe importing or maybe working to see how we localize. Also, I think it's important to note that our partner, Suzhou Inovance, they are one of the largest in China. Their revenues are almost like the group revenues are over 4 billion, and their automotive business itself is more than $1 billion. So very sizable company. They are dealing with a lot of larger players globally for these EV products. So I think that also gives us a head start in terms of your discussion with your local customers.
Okay. Sunil, I just want to sort of get a big picture perspective with you as well. You ended the previous fiscal with revenue of over 14,000 crores, right? And I mean, a lot of different parts of the business are firing. If I have the right numbers, your EV order book is close to about, I think, 3,800 crores. So just give us the overall snapshot for this year as well. To what extent will you be able to grow the EV business? And, is it at similar margins to the rest of the business? As the EV business grows, basically, is there any reason to expect an improvement in the margin profile? You're at about, I think, 11.5% margin, right, as of FY24?
Yeah, it's 11.3. So year on year, we increased almost 20 basis points. But to the order book, as we said, I think number is right. 3,800 crores is the annualized revenue we speak about. It's not a cumulative order book. We always speak about the annual peak revenue. And this is, as I said, this is all based on what our customers are guiding us, maybe inside like FY26 or 27 in terms of the volumes which they have guided us. And always the volume is the sort of a joker in the pack. But yes, that's a number. In terms of margins, I would say a little early to comment on, because as of now, volumes are very less. But as you move forward, as you build scale, as we achieve those kind of revenues, we do expect the margins to be broadly in line with our average margins. But yes, they are as of now a little lower because, as I said, the volumes are small, the costs are all fixed, and also there is a lot of product components. So all in all, yes, margins today may be a tad lower than what our group average margin is. But as we move forward and as volume ramp up, we do expect improvement in the margins as well.
So just to clarify, when you say order book of 3,800 crores, so I mean that's annual. In FY25, you're expecting to book revenue of 3,800 crores from the EV business, correct?
627.
26, 27. And where is that revenue number now for EV?
So as of now, if you see our revenue number for EV segment and for the last quarter, because I think it's important to see run rate because market has been growing sort of phenomenally. So last quarter, I think we have delivered almost 180 crores. So if you analyze that, there is almost like 700 to 800 crores of the sales for last quarter in terms of analyzed number.
Okay, just one final clarification on this TLA that you'll have signed. Will you all be paying some royalty? If yes, could you quantify it?
No, I won't be able to quantify, but I think in every relationship, every joint venture, you have a technology partner who brings on board the technology. You obviously pay royalty in return, and also as Uno Minda, we also get some sort of a management fee to run the operations and all of the support to the joint venture. So it's sort of a win-win. It's a partnership approach. And yes,
but you can at least give us a rough number about the royalty, the technology you are getting, which is fabulous and is showing good growth potential, good kit value as well. But what could it be? A couple of percentage points. Just give us a rough range at least.
Very difficult, Nigel, as of now. So it's a little confidential information, so we'll not be able to share the number as of now.
Okay, Sunil, you've given us what you could. Next time around, hopefully you could give us the royalty number as well. For the time being, you're seeing this collaboration good for you. It increases the kit value. It helps you all in the four-wheeler powertrain as well. And revenues could scale up to higher levels by 2030. Kotak puts that number at around 2,600 crores. Thanks a lot for joining in and filling us in with those details. For the time being, though, we'll slip into a short break with news that the markets are holding strong. We'll get chatting with Varun Lovchab, the head of institutional research at HDFC Securities, for some market talk.
Welcome back. So this is a market that's holding on to a gain of about 0.5% on the index. And that's the Nifty. The Bank Nifty actually is in step and is managing an equal sort of a gain as well. SBI, about 3.5% on the higher side. The story of the morning is a rebound in PSU stocks. And as of now, I mean, at 9:45, it's still intact, but it's a long day ahead. So let's see how it goes. Let's take the conversation forward. Varun Lovchab of HDFC Securities is our next guest. He's the head of institutional research over there. Varun, good to have you on the show. I was just going through your note and, it seems that you have had a bit of a cautious stance even before elections and now, given the new reality, that continues. But tell us what you've made of all the things, this huge volatility. And the big debate right now is whether the capex tilt is going to shift a bit to rural, to more mass, to more populist. And therefore, if that's the kind of portfolio shift that investors also need to look at.
Yeah, hi, good morning. So correct, I think the volatility has been very high, but if you look at YTD returns, they are still in that 3-4% zone. So despite going up, down, markets have been largely flat, and which is what our point was in February when we had written a note that going forward, next 12 to 18 months, returns are going to be quite muted across all the three indices, which is large, mid, and small cap, and we still continue to hold that view. In light of the elections, I think the only change that we probably foresee is some degree of shift in expenditure towards the rural or bottom of the pyramid or social schemes, whatever way you want to call it. Because till now, in the last 3 to 4 years, it was entirely capex and infrastructure heavy. While we believe that will still continue to grow, but anyway, given the high base, that growth was expected to slow down, and now given this pushes and pulls of a coalition politics, and government probably would like to revive sort of demand at the bottom of the pyramid. So there would be some reallocation of resources in our view. With that context, anyway, now even before the elections, we had increased our weightage on consumer staples after being underweight for 4 years. Again, combination of two things. The pendulum had swing in terms of valuation on the other extreme, where the investment and capex heavy sectors had very unfavorable risk reward, and whereas some of the more the staples or the bottom of the pyramid facing stocks had a better risk reward. So irrespective of election outcome, I think the probability of making money was higher on the other side, and now this event acts as a trigger. So I think investors should definitely reallocate a part of their portfolio away from capex and industrials into consumer staples, maybe some of the large cap IT where valuations are fine. And actually, after 4 years, first time, it's that we are not seeing value across any of the sector. So till now, we were running a portfolio where we had a value and economy facing sectors bias in our model portfolio. But now we believe, we are not seeing any very attractively placed sector. Consumer staples on a relative basis is fine, but on absolute basis, I would not say again that it offers value. So I think it will become more nuanced, more stock specific. Sectoral calls will matter less, and overall returns will be muted, irrespective of the election outcome, because the earning growth for FY25 is expected to be in single digit for our coverage universe. So there is a slowdown in earning growth, not because economy is slowing down, but because the earnings had normalized in FY24, and FY24 was a bumper year of earnings, and on that base you will see a muted growth. So I think if one is comfortable with slightly more moderate return expectations on their portfolio, it should be a good year of it.
All right. Hi, Varun. Good morning and good to see you. And just to clarify, from your coverage universe, the earnings growth you're working with is high single digit, right?
Yeah. So
and on the Nifty, it is low double digit.
For entire coverage universe of 226 stocks, it's around 6% because it is getting pulled down by select OMCs and all. But at a Nifty level, it would be close to 9 to 10% if I have to look at our stocks which are part of Nifty.
Okay, all right. Varun, I wanted your take on the PSU theme. If there has been one flag bearer, it has to be the PSU stocks. The entire basket was available, I think, for 15 lakh crore of market capitalization. Just before the election verdict, it went to around 75 lakh crore, 76 lakh crore, if I got that number correct. How do you approach this theme? Because some of them have priced in some of that good news. But your approach, are there still pockets that you would like to get in? Or for the time being, you'd like to avoid that pocket because the big money has already been made?
I think there is nothing too attractive left in PSU. At the same time, what we have been saying, and we have been holding some of them for last 4 years. We had GAIL, we had SBI, we had Pargrade, NTPC, Coal India, quite a few of them in our model portfolio. Even, the OMCs and ONGC at some point of time in last 4 years. But now, I think relative attractiveness of some of them has gone away. So I would not say that some of these names, I think, are still reasonably priced, and that's why we have not exited all of them. We still continue to like SBI, we still continue to like, NTPC and Pargrid. But, the weights have been reducing because now there is no extra value being provided by these. If SBI is at 1.5 time price to book and other private sector good quality banks are at 1.8, 1.9, then there is no big sort of a value left adjusting for the ROA. So they is still reasonably priced. I would not say that all PSUs are overpriced and one should completely exit. But some of the pure momentum ones which are not backed by earnings and where there is too much euphoria and retail action, those should definitely be avoided. I think the kind of PSU rally we had 12-18 months, we believe that will probably come to an end. It would again become more nuanced, more stock specific rather than a broad PSU theme.
Okay, all right. What about this fear that, the balance between capex as well as populism? How do you expect, the newly formed government to navigate between that? Because some on the street believe that maybe capex takes a bit of a backseat and there'll be some populist measures. The other part says that, well, even the allies are growth oriented. So that's unlikely to happen. How you view this?
So I think there are 2-3 things. One, being populist doesn't mean that you are not growth oriented. So I think the way we see the budget to be presented, one, there won't be a complete 180-degree shift away from infra to just giving money in the hands of the bottom of the pyramid. I don't think the government would do that. They would still continue to increase spends on infrastructure and capex, but at the same time, they will reallocate some allocation to higher allocation towards social schemes compared to what we have done in the last few years. Plus, they might come up with some new flagship schemes to revive, bottom of the pyramid from a 3 to 5 year perspective. So I don't think anything knee-jerk and short-term will be done by the government just to kind of spur immediate demand at the bottom of the pyramid. The good part is the fiscal position is strong. The tax buoyancy is good. And in that context, I think another view which we have is where the fear is that probably government may not follow the fiscal glide path. We have written very clearly in our note. We expect that government will not deviate away from the fiscal glide path, which means overall they will remain fiscally prudent. And the good thing is they have some headroom given good tax buoyancy to reallocate say 1 to 2 lakh crore from extra money which they would have probably spent on capex before this election, now probably to reallocate to more social schemes and bottom of the pyramid. But again, it may be more structural with a 3 to 5 year view. There might be some new schemes coming up, which is something to be looked out for.
Okay, Varun, let's see. I think the next couple of days will be very interesting because we'll have more clarity on some of these aspects as we get closer to the budget. But thank you very much for joining in. Really appreciate you being with us on the show today. Okay, quick check back on the market. Mid-caps are zooming ahead, 2.2% up on the mid-cap index. The advance decline ratio is extremely buoyant, over 2,000 stocks advancing. And the PSU boys, they're putting on some more weight and momentum. Look at BHEL, now 15% move on a BHEL, Hood Code 9%, Aircon. I mean, these stocks opened with a pop of 4, 5, 6%. Now they're, heading towards, the high single digits or double digits in some cases. Aircon is up about 9% as we speak. NBCC, RVNL, REC, PFC. So it's a long list. And this seems to be the momentum trade, at least of the day, at least of the morning, if not the day. I guess these days you just don't know, right? Better not say day, just say the next couple of hours.
I mean, yeah, absolutely. For now, right? Yeah. But moving on, Titan aims to break even for all the businesses by 5/27. That was the word which came in from C.K. Venkatraman, Managing Director of the company, during a candid chat with my colleague Mangalam Malu. The company is targeting over a 20% CAGR growth in the eyewear business in the next few years. Listen in to a slice of that conversation here.
We got into multiple categories over time, and in almost every situation we chose categories which are underserved, underpenetrated, unorganized, and that's been a strong formula for the company, virtually right through. And so eye care came in, 2005-06 time, then 2013 we got into perfumes. 2017 we got into Tanera and the Indian ethnic wear, and more recently into bags. So all these categories are, defined by those dimensions that I said, and in each one we see tremendous opportunity for organizing, for serving customers better.
Ajay, I'd like your thoughts first on the competitive intensity in the jewelry space. What would you do to turbocharge growth in the jewelry business going forward?
I think competitive intensity in jewelry has always been high because it's an unorganized market and large number of players. It's also a huge category, right? It's about 500 to 550,000 crores. And obviously it's going to attract more and more players. But for us, we are still, high single digit growth market share. We are only at about 8% market share. So the headroom is huge, both in terms of share gain, as well as if I look at the dispersion of segments, be it markets, as well as maybe different segments, be it high value studded, be it wedding, regional markets. So the opportunity for us is huge, including the small town opportunity. Middle India is a huge base in India. There are 500 towns in the 1 lakh to 1 million population strata, and we are present in only about 180 of those. While we don't know if all 500 towns will ever get ready, but the headroom again offers a very large opportunity for us. So all in all, I would say the share gain opportunity is so huge that even if 5, 6 more big players or competitors come in, there's opportunity for everyone.
So to that extent, say over the next couple of years, what would your store rollout plan be, and what's your aspiration here?
Over the next 3 years, we see, easily we can add about 100 plus stores in Tanishq. We can add about 150 to 200 stores in Mia, and certainly 100 plus to 150 stores in Carrot Lane. Zoya also there's an opportunity, but there we are not looking at large number of stores. So in totality, the opportunity to add 300-400 stores is very comfortable.
One of the concerns that the analysts had, was the ability for the company to grow its margins from current levels. In fact, 12 to 13% was the guidance, saying that over the next couple of years, it may be at the lower end of that space itself. So should one believe that these issues right now are structural, or are there levers to improve them further from here?
I think at an overall domestic jewelry business, we shared that EBIT margins would be anchored around the 12% mark. And while there will be ups and downs quarter to quarter, but on an annualized basis, that's where we hope to. I don't know about growing the margins. Yes, with a certain operating leverage, it can grow. But in the medium term, we expect it to be around the 12% mark.
The variables, the way they are growing extremely fast, now at around 13% of the portfolio, what is the delta at which it is likely to continue to grow? That's one part. And the other part is the luxury watches that you all spoke about. Give us a sense of the scalability there.
So for the watches and wearables division, these two are the big growth levers. The premium watch business is something that we have gotten into with great gusto only over the last year or so. And we have brand play with brands like Titan Edge, Nebula, and Xylus. And these brands are doing exceptionally well, given the overall premiumization wave in the country. So that vertical will do very well. It's both because of the opportunity and the tailwinds, and also because of the exceptional work that the team has done in terms of design, horology, including materials, our own movements, finish, as well as the retail side, really improving the customer experience for buying premium watches. On the smartwatches side, after explosive growth for 3 years, we see a certain cooling off. Also, a lot of price wars are going on. So at this point, we are very focused on our own portfolio. We have fast-track smartwatches, which are really between, say, 1,200 to about 5,000 rupees, and Titan smartwatches, which are above 5,000 rupees.
And what would good growth in terms of numbers be, according to you?
That's hard to say right now. Like I said, after 3 years of growth, IDC is actually predicting 0 or even negative growth. So at this point, we are looking at a good double-digit growth, but it's a pretty volatile situation, and we would wait and see how that pans out.
For the overall portfolio, what would your projection be, say mid-market and the luxury end, which is doing a lot better? So if one has to, look at your watches and wearables portfolio, segment it, and say these are the ones which will be growing faster, these are the ones which will be growing at average, what would that be?
So premium would grow very fast on a much smaller base. The mainline analog, which is a large base, would grow around 15%. The overall portfolio is likely to grow between 15 to 20%.
And how much is premium as a percentage of your overall watches and wearables portfolio?
Right now it's small. It's much smaller.
5% or a little less than that?
Premium is right now about 6-7% of the overall analog business.
Is there a way you can get your products faster to the consumer than what it currently is, and what's the kind of approach here?
One, of course, is our retail footprint would expand and probably expand quite rapidly.
What's the number there?
Yeah, so FY27, I would expect not less than 1,200 from 900 today. But we do believe we can solve for the single vision customers' requirement online, and more people, once they experience us, they would have total confidence to order online. This is going to happen, and the partners like Amazon, Flipkart are also quite likely. They don't play prescription eyewear. They would probably work with us to make sure that the reach is way bigger than what we could reach as a mono brand. So speed, access would probably come together.
Are you considering QCOM for sunglasses?
In fact, we are just starting.
Next 3 year CAGR on the revenue and margin aspiration?
20% plus CAGR and about 12% EBIT margin.
How about you?
Again, 15 to 20% CAGR, 12 to 14% EBIT margin.
It's 15 to 20% CAGR on revenue and anchoring the EBIT around the 12% mark.
For all the other businesses, they'll have to ask you.
The sum of all this.
At what point do they turn profitable? And
We're looking at all other businesses, reaching a break even, together reaching a break even by FY27.
Okay, well, that's the punch. Right at the end, that's an interesting conversation with the top team at Titan, which was conducted by my colleague, Mangalam Malu. We'll take a quick commercial break here. The market's up 132 points. Mitesh is with us, I'm told right now. Mitesh, good morning again. Thanks for joining in. We're up 140 now on the Nifty. So on the index, is there a trade? And in terms of specific stocks, what are you watching and what would you like to do?
Prashant, not taking a trade on the index, because as I said, it's been very volatile and I'm still waiting it to settle down a bit so that we get a clear picture of the trend. But yes, the good thing today is that the volatility indicator is subsiding. So I think in a day or two, we should be better placed to take indexes on the trading side. Currently, I have a buy on HUL. Now, we've been talking about positiveness on the FMCG sector, and today HUL is down and it's given a pullback and it's hit the important gap support area. So I think keep a stop loss just below today's low of 2518. So I would recommend 2515 and look for targets of around 2650 here. The other space which has come into focus is the IT space, where I think a lot of stocks are trying to reverse from oversold levels, and HCL Tech is one of them. So that's a buy with a stop below 1360 for a target of 1400 to begin with. So eventually we might look at higher levels.
Okay, all right, Mitesh. Thanks for that. Those are specific sort of trades as well from Mitesh. We'll take a break. We are back. Commodities back in focus with Manisha when we return. Stay with us.
Welcome back. So the equity markets managing to hold on to some green this morning. Let's find out what's the latest in commodities. We have Manisha with us in the studios now. Manisha, morning once again. So what's looking interesting to you?
Well, gold, and you're talking about jewelry right now. I want to talk about the gold prices, which overnight have gained up by $50 an ounce. So it has been a huge run-up that we've seen in gold. Yesterday, same time, we were trading around $23.20 an ounce. We're trading at $23.70 at this point in time. Well, it has to do with the decline in bond yields on weak U.S. private payrolls data that has led to buying come back in case of gold prices there. So it has been almost 1.5% of gains that we've seen in the gold prices for the Indian markets as well as trade opens today. Well, apart from that, the CME Fed Watch tool suggests that there is now a 67% chance of a Fed rate cut in the month of September. Well, this is something that the markets have been betting on for a very long time, that the third quarter of this year is when you will perhaps see the first rate cut come in from the US Fed. Well, this comes in on the back of the rate cut that we already have seen come in from Bank of Canada by 25 basis points to 4.75%. But this is the first time that you've seen a rate cut come in for 4 years. This is much on expected lines, so the industry was anticipating it. There's an anticipation that another rate cut from Bank of Canada could actually come in the month of July as well. But apart from Bank of Canada, it is the European Central Bank meeting that the markets are watching out for today. A 25 basis point rate cut is something that the street has already factored in coming in from ECB as well. And then when you look at the third quarter, it's not just the US Fed, but there are expectations that Bank of England and Bank of China could also be lowering rates by at that time. Well, the global central bank have been buying gold quite strongly. The month of March wasn't so great, but for the month of April, a 33 tons net has been purchased by the global central banks. Well, within this, it's about Singapore, Kazakhstan, Russia, even India, which have bought gold in the global markets there. Well, the markets also are looking at reforms coming in from the Indian sector. Remember, we are the second largest buyers of gold. So the new government, what is their approach towards gold and whether or not there are any reforms coming in is something that the global markets are also looking out for. Well, that's about gold, but take a look at silver, and we saw strong gains onto this one as well. A percentage and more of gains in the overnight market. We did see prices decline below 30, but we are trading back above 30 at this point in time. Clearly off the 11-year highs of $32 that we saw in the last week of May there. Well, here as well, the street is watching out for the deficit in the global markets, strong industrial demand, and the fact that the US has imposed 50% tariff on Chinese solar cells, where silver clearly is a major ingredient there. So that's a story that the street will watch out for. If you look at the prices then on what the gold and silver have done on a week-on-week and a month-on-month basis, well, gold has turned positive for the week, silver hasn't. But when you look at a month-on-month prices here, silver continues to outperform. And on an year-on-year basis as well, silver continues to outperform. So good going when it comes to silver versus gold there.
All right, Manisha, thanks very much for that. So that's commodities and the lowdown there. Well, let's talk about PSUs, right? BHEL is one of the top volume-led gainers. NBCC, there is news flow with an order. Vivek is here with details. Vivek, morning.
Well, good morning. Like we mentioned earlier today, BHEL continues to see its robust order book grow quite significantly. So last evening, they've informed the exchanges that they've received 2 sets of orders from 2 separate subsidiaries of Adani Power. Number one is an order that they've received in the state of Uttar Pradesh. Now, this is for a supply of equipment to Mirzapur Thermal Energy. This is for a 2 into 800 megawatt thermal power project. Now, the company will be supplying both boilers, turbines, generators, as well as associated ancillaries. The size of this particular order is over 3,500 crore. Similarly, in the state of Chhattisgarh, now this particular equipment supply will be again 2 into 800 megawatt power project at Raipur. Size of the order is similar, over 3,500 crore. So today, BHEL has declared orders worth over 7,000 crore. Now remember, at the end of Q4 and at the end of FY24, they had an outstanding order book in excess of 1.31 lakh crore. So the order book there stands very, very strong. Now talking about NBCC, the company reported to the exchanges last evening that they had received multiple work orders in the normal course of business worth over 490 crore. On the back of the orders, you're seeing the stock move higher today.
Okay, got it. Thank you very much for getting us the latest on those stocks and why they are buzzing today. Let's also look at, thanks for that, Vivek. Let's also look at Century Textiles, and that's a stock that's been up around 10%. And this is back on the back of some real estate development that they're looking at. Sonal has more details here. Sonal?
Well, Century Textiles wholly owned subsidiary, that is Birla Estates, has entered into a joint venture which is with Barmalt India Private Limited. They will be developing around 13.27 acre of land parcel for a luxury residential group housing in Gurugram under this particular joint venture. The development potential is approximately 2.4 million square feet, and it will offer them a revenue potential of up to 5,000 crore rupees. And remember, NCR is a region where a lot of new developers are entering. They're not new here, but of course they're expanding their footprint in the NCR region region as well. Remember, the stock is up 67% in last 6 months itself and adding on to some gains. So Street likes the expansion plans that they have in the NCR region.
Okay, all right. Century Textiles there. Real estate play. I mean, it's been seen as a real estate play, but I think now that there is front and center, the real estate part of the business. 2061 on that one at this stage. We'll take a quick commercial break here. We'll come back and our special segment, it's the economy. My colleague Lata will be chatting with Abhishek Upadhyay of ICICI Securities and Suyash Chaudhary, head of fixed income at Bandhan Mutual Fund for a bond market perspective. Stay with us.
Welcome to It's the Economy. The equity markets have recovered much of their losses post the exit poll, but the bond market has not. On Monday, the 10-year bond yield fell to a low of 6.94, a historic low actually, a multi-year low on the exit poll, indication of a resounding victory for the BJP. And on Tuesday, after the results, the yield rose 10 basis points to 7.04. Now, despite assurances that the Narendra Modi government, Narendra Modi and the NDA will form the government, the yield is stubbornly at 7.02, so not quite recovered. What are the bond market's worries? Can the Reserve Bank's monetary policy statement assuage the bond market's fears? Where are yields headed? For all this, we are joined by Abhishek Upadhyay, the senior economist at ICICI Securities primary dealer, and Suyash Chaudhary, head of fixed income at Bandhan Mutual Fund. Gentlemen, thank you very much. I initially intended this as a, credit policy heads up, but now, the complications in the bond market are more interesting. So let's start over there. Abhishek, your thoughts. Why the worry? Why are we not seeing a recovery despite the fact that, the assurance of a reasonably stable government is there?
Well, Lata, so bond market clearly, in contrast to equity markets, is more worried about the uncertainty bands around the fiscal dynamics. In the run-up to the exit polls and election results, the market had been buffeted by two key favorable developments. One, of course, RBI dividend payout, which had been far larger than was priced in the budget and assumed by markets as well. It was assumed that the roughly 0.3%, a little higher fiscal largesse coming from that side could potentially be used for additional fiscal consolidation. That expectation had been boosted further by the provisional data, fiscal data that was released again end of the month, and which indicated fiscal deficit for last year was 0.25% of GDP less than was assumed in RE. So all these two factors together meant that the cash balance which government was running currently is almost 3.5 times the cash balance it was running same period last year, and that this could potentially be used to cut the GSEC borrowing program, which was assumed in the revised estimates. But now, with there being bigger uncertainty, I don't think markets are assuming a regime shift in fiscal policy. Still, the assumption is fiscal deficit will be around the same ballpark. But that expectation of a big borrowing cut that was likely to be announced otherwise there is a wider uncertainty band around that expectation, and the market anxiety reflects those worries.
Okay. Now, fair point. We were flashing that as well. The expectation of a borrowing cut was very much beginning to simmer. But Suyash, what is your estimate? Is there an expectation that the fiscal deficit will be higher than 5.1? Is that a fear at all? The more important buzz I hear is about the MSP. Given the rural distress, which is now very obvious in the poll results, do you think MSP will be raised, and will that have impact on the bond market, or is it already getting discounted?
So Lata, Abhishek summarized it well. I think the delta here is the expectation earlier that there would be a supply cut basis the excess dividend, which now market I think is veering around to the view that there'll be no bond supply cut, and the excess will get basically used to push up revenue spending. Beyond this, I would not hypothesize too much. See, part of the weakness is consumption demand. Will have to balance forward in a change in mix between revenue spending and capital spending. I would think the government's focus would have been generate enough forward multipliers by upfronting capex spending. But if you see, the year-on-year growth rates of revenue spending versus capital spending, probably over a period of time, that starts to turn a bit, which is absolutely fine from a macroeconomic stability standpoint as well. Look at also, for example, the composition of core inflation, where or other headline inflation, where core is at 3.2% and food is at 8.5, etc. So that also needs to rebalance somewhat going forward. Look at the composition of real GDP, where personal consumption is growing at 4% and capital formation at 9%. So there is rebalancing pending, and it would anyways happen. And I think it's partly unrealistic if one expects that, revenue spending grows at the current pace and capex spending grows at the current pace. And, we don't worry from a macroeconomic standpoint at all, because eventually the variable one has to track is current account deficit, which is basically the summary of net dis-saving at each of the public sector, private sector and household level. And that is absolutely...
Those have not changed much for the market. Obviously, the near-term fear is probably higher fiscal spending, and definitely the hope going away that borrowing program will recede, will be cut in some fashion. Some 10, 20,000 crore, even that is now out of the window. But Abhishek, is there a bigger fear that we have to take into consideration? The Agricultural Department released some data showing that potato and several other products output is lower than estimated. Do you think that we should be prepared for something in June itself? I'm just coming to the monetary policy in a bit. Is there a likelihood, if the MSP is raised, is there anything that can impact inflation and therefore bond market immediately?
Well, so what we have seen over the last few years is that correlation between MSP hikes and food inflation for specific commodities, it has come down a bit, partly because market prices anyways have been higher than MSPs. So to that extent, it is less harmful. But yes, we need to see the exact nature of policy making on that front. It could have some bearing on food inflation dynamics, which RBI anyways is watching more closely. But my baseline assumption is that inflation dynamics remain very favorable. Underlying inflation, in fact, is settling down below 4%. I would say between 3.5% to 4%. Even food inflation, while it looks very high right now, is predominantly on account of very volatile items like vegetables, etc. Underlying food inflation, again, is around that 4% or slightly lower as per different metrics we track. So not very worried about inflation. And I do believe that even if you do get some surprise on MSPs, etc., that you're pointing out, our assumption was that inflation this year could well average below RBI's forecast, which is 4.5%. So there is some buffer there for inflation to go up, even to meet RBI forecast.
Oh, that's a very big relief, especially for equity market watchers who don't look at these things very closely. this fear goes out that food inflation could be a bother. And then, of course, let's remember that this is supposed to be a La Nina year, and maybe that also would be a positive in terms of food prices and output. Suyash, now to the monetary policy, what would the RBI do in a context of uncertainty about the budget?
So, Lata, I think it is a steady as it goes kind of policy. RBI doesn't need to do anything at all. Their focus since late last year has been more active liquidity management, which is different from how this entire rate hike cycle was conducted. So you'll recall that the move from 335 on the overnight rate effectively to 6.5, going up to 675 later on. But most of this was conducted in a period of heavily excess liquidity. And the liquidity framework has always been about, since 2020, that you have to target weighted average overnight rate using variable rate auctions, not really focus on quantum of excess liquidity. Our sense is, RBI may have been worried about pockets of excessive credit growth, and therefore they wanted to ensure bigger transmission of historic rate hikes via more actively channeling liquidity. Now, one has to see going forward, you are seeing distinct signs of unsecured credit growth slowing, loans to NBFC from banks slowing, and whether that starts to give some comfort to RBI to let loose a bit on active liquidity management, in a sense that if the excess core liquidity translates going forward to headline liquidity going up via government spending, how proactive the RBI is going to be to absorb that excess. Okay. Our guess is in the first phase they would continue to be, but as time passes, probably towards the end of the year, RBI will also be slightly more relaxed on liquidity. But for this policy, there's really nothing much we can see that they need to do.
Okay, just the one word on policy from you, Abhishek. Overall, will they leave you with a dovish tilt or a hawkish tilt?
It will be neutral, as Suyash pointed out. We don't expect any change in key policy settings or in macro projections. They should have that risk management mindset, given that there is still a little bit of uncertainty about how fiscal policy will evolve. They should use these arguments on the monsoon front, on the global Fed policy front, and now, these fiscal dynamics, which they will not point out, but all this to indicate a steady policy. Maybe August or October policy meetings could be more relevant to more closely evaluate any need for shift in policy communication and settings.
The more important number we want from you is the guess on the 10-year, because the equity markets really ran up the PSU basket, because obviously they have a huge amount of stake in bond prices remaining high. Now, PSU banks took a hit. A bit of recovery has come, but not all of it. If you look at the month-to-date or the week-to-date performance, PSU bank stocks still remain laggards. So, Suyash, on that, what would your trajectory for the 10-year be for the month, for the quarter?
So, Lata, I'll conveniently sidestep the numeric question, but I will lay out a more general summary philosophy. We think probably India is at the cusp of a structural run in fixed income for a variety of reasons, including improving macro, the scale of India, the bond index inclusion, and US macro policy, which is probably leading to long-term dollar re-rating or de-rating. And we think, the next 2 to 3 to 4 years, India is probably a structural market. In the very near term, there is some sign that US consumption weakness is beginning to show through. If the Fed were to start to signal a change to the cycle, then, bond yields here will also start to drop more meaningfully. But we are reasonably convinced that over the next 2, 3, 4 years, we are looking at a bit of a structural market in India fixed income.
Okay, and this is despite the political setup?
Yes, because we are assuming still broad macro policy continuity, which we are happy to continue to assume.
Yeah, of course, there is Sachs buoyancy. There are other reasons, I agree with you. And a long-term inflation targeting also now part of the DNA of the policy. Abhishek, your thoughts? We also want a near term. It's very good to hear that India is probably in a medium term or a longer term bond bull market. But for the near term, for the month, for the quarter, because it so determines the PSU banking stocks, how would you look at the 10-year yield trajectory?
Assuming fiscal deficit, is close to RE in the upcoming final budget. And our assumption is there are no rate cuts that are likely in the current CY. Although markets could try to price in that, especially if global developments are also favorable. So in that light, we think 690, 710 kind of range should continue to play out. Earlier we saw bond yields trading in the 720 kind of a range. But now, assuming there is still some likelihood that dated borrowing program, there's still some probability it could come down. So, given these expectations, we think maybe 690, 710 kind of range could still hold.
For the quarter, you mean?
Yes.
Okay. Gentlemen, thank you very much for giving us a picture of what to expect from the Reserve Bank and more importantly, how to approach the bond market. Just a final quick question. I just want a numerical numerical or yes, no from you. Any changes to the growth or inflation forecast, Suyash?
No.
Earlier, we were expecting an upward thrust actually to the 7% GDP forecast. Anything RBI will tinker?
Probably too early, no.
No. Abhishek?
No.
No, 7% GDP and 4.5 CPI would perhaps remain. And with a bit of luck, we did have one shower in Mumbai. If the rains are munificent, bountiful by August, perhaps we could have some readjustment lower on the inflation forecast. But there is time for that. Thank you very much, Abhishek and Suyash, for joining me. We will know, of course, what the RBI is thinking exactly 24 hours from now. 10:30 tomorrow, we should know what the Reserve Bank has decided. We wrap up on Bazaar on that note, and Chartbusters will take the action forward. And it's a very, very buoyant stock market. 1% higher on the big indexes, 2.5% on the mid caps.
The Indian market opens strong. Bounce back from counting day lows continues. Realty, IT and PSU banking stocks lead the gains. It's the mid-caps that significantly outperform the frontliners.
BHEL jumps more than 12% after the company wins 2 orders worth over 7,000 crore rupees from subsidiaries of Adani Power.
NBCC2 climbs on the back of order wins as it gets multiple work orders worth nearly 500 crore rupees. The stock is up around 8%.
RVNL also surges as it receives a letter of acceptance for a project worth around 391 crore rupees from the Eastern Railway. The stock is up nearly around 8%.
The FMCG stocks, after 2 days of rally, take a bit of a breather as we are seeing some bit of profit taking after hitting near record highs. The sector comes in for profit booking.
Hello and welcome to CNBC-TV18 HDFC Sky Election Headquarters. I'm Nigel D'Souza and joining me as always is Mangalam Malu. Well, Mangalam, boom, boom, boom. Yesterday, in fact, we were up close to around 700 points. Today, we're up another 250 points. And what a move we are seeing, Mangalam. Just a few sessions ago, we went down close to around 21,300. And in a matter of what? Less than 2 sessions, we've gained close to 1,500 points on the Nifty. Wild swings.
Wild swings, Nigel, and it's interesting. Yeah. Even if you account for the volatility that we saw in the last 3 trading sessions, and you discount all of that, from Friday's close to now, we're still up around 300 points on the Nifty.
Indeed.
All of them are doing well. All of the indices, the Nifty bank just below that 50,000 mark, and the mid-caps, they are swinging hard. I mean, it's the T20 World Cup, which is currently underway in the US and West Indies, but out here, if you look at them, all of them are playing like it's the power play overs right now. Big moves. 2,000 stocks advancing for just about 180, which are on the lower side.
Well, that's right. Mangalam, stocks like HAL, they are up close to around 10% as we speak. But if you look at it week to date, actually, those stocks are still negative. Yep. Despite this big bounce that we're seeing from the lows, BEL as well, that's up close to around 7%. But I'll tell you what, for the week, it's still down close to around 5%. So there's a big bounce back in some of these PSU-related names, but some of them are still mildly negative for the week itself. Some of those, political as well as fundamental-related stocks, JSPL, we had pointed it out yesterday as well. The stock was a little bit lower. It's moved back into the green now. It's up close to around 3% from the low point of the day. IMFA, that's Indian Metals and Ferroalloys, well, that stock as well had started off a little bit subdued. That's recovered. And KCPA, that's the other name. So 3-4 of them. Add to the list, Maharaja. For this week itself, that stock is up. You have, I think, the other one is Heritage Foods. That's up 45% in 3 sessions. Wow.
Absolutely, Nigel. Those stocks are doing extremely well. But, on the PSU front itself, I'm just looking at SBI. SBI is one of those rare counters which has actually turned positive for the week as well. Even as we saw a bit of selling in a lot of these PSU stocks over the last couple of days, and from those extremely sold levels, we are seeing a bit of a bounce back. So the bounce back looks big in today's trading session, but like Nigel pointed out, in perspective from where they were at the start of the week and to now, most of them are still in the red by a few percentage points. SBI, on the other hand, if you just take a look at this week's chart itself, despite all the volatility, a near 10% up move on Monday, thereafter a big decline day before yesterday, and then some recovery today and yesterday. The stock up 5.5%, 831, makes it absolutely positive for the week, in line with where it closed on Friday itself. So this is one of those which is doing well. But let's welcome Sachidanand, who take care of Trade Bulls, for a quick technical check on the market. Sachi, if one was to look at the market, on Friday to now basis, they wouldn't think that this is a week where we saw such wild swings. But be that as it may, after this recovery, what are your projections on where the market goes from here?
Good morning, Nigel. Good morning, Mangalam. Clearly, I think the recovery has been very steady. In fact, Nifty has again re-established that particular base at 22,200, and since then, there has been a very steady, up move, and even the sector rotation has been very confident. So right now, I think from a momentum perspective, we may see this particular, rally getting stretched right up to 23,200, 23,100, and probably we may see an extended move post that. But as of now, the volatility has already cooled off. We are all back to business trends. So I think eventually we may see Nifty scaling towards fresh life highs. But as of now, So far as 22,680 is held on, probably we may see the continuation of this particular move. We are anticipating that today's expiry could be somewhere close to around 22,940, 23,000 itself. So I think this bullish momentum may stay.
Okay, all right. What about individual stocks then? You're saying that the bullish momentum can stay. 23,200 could be the near-term pit stop that you're looking at. What about individual stocks?
Nigel, there are two stock ideas on our radar. First of all, we have recommended these to our clients as well. Now, we have already seen a very strong pullback rally in all the PSU names. BPCL is one particular counter wherein the reward to risk is still favorable. It is forming a fresh floor at around 600 zone, and we are expecting that there could be a push towards 640 in a day or so. That's why we're recommending building long positions in BPCL, keeping a stop loss somewhere close to around 590. And we may see a swing towards 640 from a trading perspective as well. The other stock which has hit our radar, wherein the recovery has been a kind of a V shape, is Bajaj Finance. Now, the stock was in a low top, low bottom structure. Despite the market volatility, this particular stock did show a lot of resilience near the 6,800 mark. Since then, we have seen a V-shaped breakout. The breakout of the pattern is indicating a target somewhere close to around 70 to 30, and that's why we are recommending building fresh long positions here. Keep a stop loss somewhere close to around 6,910.
Right, Sachi, before we let you go, would you think that the FMCG spark that we saw in the last couple of trading sessions, is there a reason for the stocks to move back higher, or the rally that was done is done and dusted?
I think this particular move may sustain. In fact, if you look at the Nifty FMCG index itself, the index was consolidating and forming a base somewhere close to around 54,000 levels. And since then, we have seen a very strong breakout. So I think there are signs that this particular trend, at least on the index, should sustain. And we may see the index itself moving close to around 63,000 mark. So I think there's a good substantial upside which is left. We have already seen very good participation from counters like HUL and ITC so far. But I think this particular trend momentum may continue from here on as well. When we look at specific stock and the performance, HUL is displaying a kind of a broadening formation with its base being established somewhere close to around 2,300, and the upper end of this particular broadening formation is placed somewhere close to around 2,930. So there's a good amount of headroom which is still available, and every decline should be a good opportunity to accumulate these counters in one's portfolio.
All right, Sachi, thanks a lot for that. Dips in FMCG do offer buying opportunities, but he did give out his views on the index as well as a lot of individual stocks. Let's talk about a lot of these individual stocks now. IEX is the one which is surging after posting a strong business update for the month of May. The stock up nearly 7%. Vivek joins in with the details on that one. Vivek.
Well, that's right. So, the stock in focus is IEX, that is India Energy Exchange. Remember, it's a short-term power exchange market. So what the company did last evening was they reported their May operational performance, and when you're looking at the performance, look at the volumes. Total monthly volumes have jumped up 29% on a year-on-year basis, coming in over the 10,630 million units mark. Now, talking about just the pure electricity volumes, up 21% on a year-on-year basis. When you're talking about the day-ahead market price, it has come in at 5.3 rupees a unit, which the company says is almost a 20% discount to the bilateral agreements that companies get into with Discom. So they believe that the short-term market is a lot more lucrative as far as power buyers are concerned. Now, what they're saying going ahead, they expect more volume action, given the fact that sell-side liquidity is improving. They attribute it to number one, the government directive that coming in on sale of surplus under question power on the power exchanges, along with that increased fuel supply, and also higher availability of generating units is something that's led to increased sell-side liquidity.
Okay, all right, Vivek, thanks a lot for that. But stay with us. So what about Torrent Power? That's in focus. The Gujarat Electricity Regulatory Commission issued an order on determination of tariffs for the coming fiscal. Explain to us.
Well, that's right. So this has been something that, the street was anticipating for a long time. Largely, this particular event is net neutral, as per what analysts are saying. So, what's actually happened? Let's have a look at the entire event. GERC, that is, like you mentioned, the Gujarat Electricity Regulatory Commission, has gone ahead and issued the order, number one, for determination of the annual rate of return and also the tariff for FY24 to FY25. Now, we passed through the entire document. The positive takeaways from this particular order are, number one, the company has received approval for all of its capex plans for this year. Along with that, there has been no change or capping as far as the return on equity is concerned. Along with that, the top charges that the company had provision for payment to Petronet LNG of close to 400 crore has been approved. However, there are a few setbacks that Torrent Power may choose to go ahead and appeal at a higher court. Number one, there has been a cut as far as benchmark T&D losses are concerned. Number two, the company is an important plant, which is the gas-based power plant, that is Sugen. Here, the PPA terms are slightly unfavorable now. The PPA term capping has been done at rupees 5.5 per unit. Now, this will be effective retrospectively since FY23. IIFL Security has written a note after this particular development. They're saying, by and large, the positives and the negatives are going ahead and nullifying themselves. They are not making any changes to the EPS estimates for the company. They do believe that the company may go ahead and appeal against the negative pointers in this particular order from the GERC.
All right, Vivek, thanks a lot for that. With that, we'll step into a short break, come back, get you on more on the markets and other stock-specific action on the other side. Stay tuned.
Welcome back. Well, as we speak, a few stocks are bobbing around. Jubilant Foodworks, well, it's moved to the low point of the day. Some kind of profit taking being seen on that one, though for the week it's still up close to around 5%. A couple of other notable movers. Loris Labs, big move out there. The stock is up close to 2.5%. Was trading in the red. And another one that's moved up as well is REC, now up close to around 10%. But the one we're going to focus on is HL. It's buzzing in trade after it inaugurated a facility to support ISRO program. CLSA as well has issued a note on the stock. Upasana joins us to fill us in with all of those details. Upasana, take it away.
ISRO chairman inaugurates HAL facilities to support LVM3 programs. Mind you, currently the existing capacity allows only 2 LVM3 launches per year. This facility will support the production of 6 LVM3 rockets per year. And mind you, post-election results, CLSA had written a note on defense sector wherein it has retained outperform rating on HAL with a target price of 4,731. It says that the expensive valuations leave little space for execution error. Company has also given a EBITDA margin guidance of 32 to 33% in next 2 years. And for FY25, the company is guiding for a order book of 47,000 crores, excluding the MRO division. As of 31st March 2024, the company's order book stands in excess of 94,000 crores, and company says that it is confident of maintaining FY24 growth momentum on the back of robust order book and strong order pipeline.
Right, Upasana, thanks a lot for that. Seems like today there is a lot of news backing a lot of these PSU stocks as well. Order wins coming in for names like BHEL, NBCC, etc. Some news coming in from the ISRO and their orders for HAL, as Upasana pointed out as well. All of that with the underperformance that we saw in the last few trading sessions is leading to this pop that we're seeing in these names. But the other one which is in focus are all these city gas distributors as well. After brokerage house Citi has published a constructive note on the sector, a second one coming in the last couple of days. We have Sonal joining in to tell us more. Sonal.
Well, there are a couple of things which are happening with these gas names. Let me start with the City note first up, where they remain constructive on GAIL, IGL and MGL as well, and these are the preferred picks. They believe consolidation in CGD sector is likely going forward, and consolidation could benefit the larger, more experienced CGDs according to them. The second thing that they talk about is something that the other analysts have spoken about as well, is a possibility of gas coming under GST in the new NDA regime, and if that happens, that would benefit the entire value chain, allowing input tax credits and reducing costs for these companies as well. The second is two PNGRB notifications. The first one is allowing these companies to establish and operate LNG terminals. The LNG infrastructure would include receiving, storing, transporting LNG via their own terminals, because a lot of these companies have spoken about expanding from their current portfolio. The LNG terminal companies, they shall submit application for registration, and they should also furnish bank guarantees to the tune of around 1% of the estimated project cost, or 25 crore rupees, whichever is less. Board, after examining the application, may issue certificate to commence operations for around 30 years. Again, this is just a draft. The third piece of news is that PNGRB has issued another notification where they actually revoked the previous notification dated 13 September 2021, which would allow more marketing freedom to all these city gas distribution companies. They say that now the exclusivity factors would consider a lot of things, not just the number of years. It would consider the location, gas availability, population and aggregate demand as well. ICICI Securities says that this is positive for their coverage companies like MGL and Gujarat Gas and IGL as well, because there was a fear of more competition coming in with marketing exclusivity ending for a lot of these other companies. They see this notification to give some relief to existing CGD players that enjoy marketing